As the markets have officially closed for the weekend, it is Saturday, November 29th, 2025. Trading on the Nasdaq has ceased, and the final numbers for the week are locked in. Navitas Semiconductor, ticker symbol NVTS, closed the Friday, November 28th session at $8.54 per share. In the after-hours session, we saw continued volatility, with the price fluctuating upwards towards the $8.97 mark, indicating that despite the closing bell ringing, institutional interest remains active. The intraday movement on Friday was choppy, characterized by a classic consolidation pattern, where the stock tested lows near $8.43 before buyers stepped in to defend the support level, pushing it back toward the mid-$8.50. This price action tells a story of a stock that is currently a battleground between short-term bearish sentiment driven by headline revenue declines and long-term bullish accumulation focused on a fundamental transformation of the business. When most retail investors look at Navitas Semiconductor right now, they see a company in trouble. The expectation, the lazy narrative floating around the message boards and surface-level financial blogs, is that this is a failing mobile chip supplier. They look at the recent earnings report, showing a massive 53% year-over-year revenue decline to just $10.1 million, and they see a disaster. They see a company hemorrhaging money, with operating losses that look ugly on paper, and they assume the growth story is dead. That is the expectation. But the reality is far more nuanced, far more explosive, and far more critical to the future of the entire artificial intelligence infrastructure. The reality is that Navitas is not failing. It is aggressively amputating its own low-margin limbs, its legacy consumer mobile business, to save the body and transplant its heart into the high-voltage, high-margin world of AI data centers and industrial energy. What looks like a collapse on the income statement is actually a calculated, strategic evacuation from a commoditized market to position itself as the primary power broker for the AI age. This divergence between the terrifying headline numbers and the strategic brilliance under the hood is where the opportunity lies. And it forces us to completely rethink what this stock actually represents. To understand why this stock is trading the way it is, we have to look at the broader market context that dominated Friday's session. The semiconductor sector has been under immense pressure due to shifting macroeconomic winds. We are seeing a rotation where capital is moving out of software and into hardware infrastructure. But investors are becoming incredibly picky about which hardware they buy. The rising tide lifts all boats phase is over. Now the market is demanding efficiency. This is where terms like NVIDIA stock and Tesla stock become part of the conversation, not just as market leaders, but as customers and benchmarks for what Navitas is trying to achieve. The market is waking up to a physical limit that software cannot code its way out of: heat and electricity. As AI models grow exponentially larger, the data centers running them are hitting a power wall. Traditional silicon chips for power conversion are too slow, too hot, and too big. This is the macro tailwind that is quietly buffering Navitas against the headwinds of its revenue drop. The trading volume we saw on Friday, hovering around 13 million shares, suggests that while the weak hands are selling based on the revenue miss, stronger hands, perhaps looking at Fidelity Investments or Fidelity Wealth Management strategies, are accumulating shares, betting that the power crisis in data centers will force a mass adoption of gallium nitride and silicon carbide technology. Let's dissect the recent earnings report because this is where the fear stems from. The company reported $10.1 million in revenue for the third quarter of 2025. That is a painful drop from the $21.7 million they pulled in a year ago. If you only look at that number, you run for the hills. However, if you listen to what management is actually saying and doing, the picture flips. They are intentionally letting the mobile revenue dry up. Why? because selling chips for phone chargers is a race to the bottom. Margins are thin, competition is fierce, and it doesn't command a premium. Instead, they are pivoting the entire company towards high-power markets. They are focusing on the sectors that are desperate for energy efficiency: AI data centers, electric vehicles, and industrial grids. This pivot is expensive and painful in the short term, which explains the net losses, but it is the only way to justify a higher valuation in the long term. The company still holds roughly $150 million in cash, which is a crucial lifeline relative to their burn rate. This fortress balance sheet gives them the runway they need to survive this transition period, often called the Valley of Death for tech companies, before the new high-power revenue streams kick in fully in 2026. The core of the bull case for Navitas lies in physics. We need to talk about gallium nitride and silicon carbide. For decades, we have relied on silicon for managing power. It's cheap and plentiful. But silicon has hit its limit. You simply can't push more voltage through it without it heating up and wasting energy. GaN and SiC are what we call wide-bandgap semiconductors. Without getting too bogged down in the quantum mechanics, this essentially means they can withstand much higher voltages and temperatures, and they can switch on and off thousands of times faster than silicon. Why does switching speed matter? Because the faster you can switch, the smaller your magnetics and capacitors can be. This means you can shrink a power supply from the size of a brick to the size of a deck cards, while wasting half as much energy. In the context of an AI server rack that consumes 100 kilowatts of power, even a 1% improvement in efficiency saves thousands of dollars in electricity and cooling costs. Navitas is claiming they can deliver significant double-digit percentage improvements. This is why the partnership with NVIDIA is so pivotal. Navitas has been qualified for NVIDIA's 800-volt DC AI factory architecture. Think about that. The most important company in the world, NVIDIA, which is building the brain of the future, has validated Navitas's technology to power that brain. This isn't just a supplier agreement, it is a coronation of their technology as mission-critical. We also need to address the recent news regarding their distribution strategy. Navitas just announced a major expanded partnership with WT Microelectronics in Asia. This might sound like boring supply chain logistics, but it is an aggressive move to streamline their operations. By consolidating their distribution with a massive player like WT, they're essentially outsourcing the sales grunt work so they can focus their internal engineering talent on designing the next generation of chips for Tesla-style EV chargers and Blackwell servers. It allows them to scale faster without bloating their own headcount. This operational leverage is exactly what institutional investors using platforms like Interactive Brokers or Schwab Intelligent Portfolios look for. They want to see a management team that knows how to scale efficiently. This signals that Navitas is preparing for a volume ramp-up. You don't overhaul your distribution network if you expect sales to stay flat. You do it when you expect a flood of orders and need a bigger pipe to deliver them. Let's take a moment to look at the competitive landscape. Navitas calls itself a pure play in next-generation power semis. This is a double-edged sword. On one hand, it means they're the only ones 100% focused on this. They're not distracted by legacy silicon businesses like some of their competitors. On the other hand, it means they have no legacy cash cow to fund their R&D. They have to win. This high-stakes dynamic creates volatility, which attracts a certain type of investor. You have the Robinhood crowd and those engaging in Robinhood stock trading who love the high-beta, high-risk reward setup. Then you have the more conservative money, perhaps managing Fidelity IRAs or Fidelity mutual funds, who are watching from the sidelines, waiting for the revenue pivot to be proven. The tension between these two groups is what causes the price to swing so wildly. Every piece of news is magnified. A small contract win sends it up 10%, a slight delay sends it down 10%. This brings us to the macroeconomic environment. We are entering a period where energy scarcity is becoming a primary constraint on GDP growth. If you follow the energy markets, you know that the demand from AI data centers is projected to triple in the next few years. The grid can't handle this. We literally can't build power plants fast enough. The only solution, other than building nuclear reactors in everyone's backyard, is to make the consumption side more efficient. Navitas is selling the solution to the energy crisis. This is a powerful narrative that transcends typical tech cycles. Even if the consumer economy slows down and people stop buying new phones, which hurts their old business, the build-out of AI infrastructure is an arms race that governments and mega-cap tech companies cannot afford to stop. This decouples Navitas's future from the consumer credit cycle and hitches it to the AI CapEx cycle. However, there are risks. The geopolitical tension, specifically tariffs and trade wars, is a